Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate documents into something you can actually understand. Today we're diving into Ingersoll Rand's latest 10Q filing, which is like their quarterly checkup report. Let's see if this industrial giant is thriving or just blowing hot air. And remember, if you like getting the inside scoop on these companies, make sure to subscribe and join our Discord community. Link is in the description below. This report covers their performance up to March 31, 2025. Think of it as a snapshot of how the company did in the first 3 months of the year. Was it a smooth ride or were there some bumps along the road? First, the basics. Ingersoll Rand is traded on the New York Stock Exchange under the ticker symbol ER. As of late April, they had over 403 million shares of common stock outstanding, meaning there are a lot of pieces of this company floating around. Okay, let's get into the numbers. Time to decode the financials. Jumping to the good part, we see that revenues were 1.76 times 8 million. That sounds like a lot, and it is, but let's put it in perspective. Compared to the same period last year, where they had $1,670, over 0.8%, that's not a huge leap, but it's still positive. Think of it as a slow and steady climb rather than a rocket launch. Now, what about the bottom line? The net income attributable to Ingersoll Rand was $186.5 million. Now, compared to last year, it was $202.2 million. If you are into stock market, this part can be interesting. Basic earnings per share went down to 0.46 versus 0.50. That's a decrease, and it could signal something less than ideal. Now, they also give us a look into what they call comprehensive income, what accounts for a bunch of other things that impacted the real numbers. A big component of it is foreign currency translation adjustments. It basically means when they convert money from other countries and turn it into dollars due to fluctuating exchange rates, the number changes. Let's check on the big picture for a moment and take a look at the balance sheet. Digging into the assets side, accounts receivable net is at 1,348.3 million versus 1,335.4. Not really that different. A very big component for them is goodwill at $8,339 million versus $8,188.08. It means that the company believes they have purchased some very valuable brands and user bases. This valuation is something they will need to account for in the future. On the liability side, total liabilities are at $7,080.25.7 million. This is actually very close to total liabilities last year, which were at $7,764.5 million. Stockholders' equity is at $10,553.7 versus $10,245.3. Again, mostly the same. Now let's scroll to a very important section of this filling, cash flow. We have tuna net income to 188.48 at 48 cash provided by operating activities, 256.664 TOEIC. You know, these look like very similar words, but it's worth noting that while net income is important, cash flow from operations means if a company is actually bringing dollars home to pay their bills. Now let's take a step back from the numbers for a minute. What are some of the risks that Ingersoll Rand highlights in their report? They worry about instability in the global economy, which could impact their revenues and customers. With more than half of their operations being outside the US, they're also subject to international risks like political changes and regulations. They also bring up cyber attacks, which is a normal thing these days for companies. Acquisitions are something that they are focused on, but integrating them has risks as well. Of course, there are always legal proceedings, but they believe these won't have a material impact. That's lawyer talk for we don't think we're in too much trouble. There were no material changes to risk factors. The company bought a 111,109 shares for almost 100 million back. This shows the company believes their stocks are worth buying, so they are making sure their shareholders are getting returns. Finally, in what they call a subsequent event, they announced their board authorized an increase to the company's share repartiment. It means they are allowed to buy $1 billion more of their stocks. So what's the big picture here? What does all this mean for Ingersoll Rand? Looking at the numbers, Ingersoll Rand is a solid company that's still growing, but the decrease in net income and basic earnings per share compared to the same period last year is something to keep an eye on. The global economy and political uncertainty in trade is a big risk for the company as well. The company does seem to be focused on buying other companies and brands, so they are trying to stay on the competitive edge of things. It also seems the company is financially healthy and have a lot of cash to keep investing in themselves and buying up more shares. So is Ingersoll Rand a buy? It's a complex situation. Long term, their strategy seems solid, but these global challenges and financial metrics need to be monitored. That's our quick look at Ingersoll Rand's latest financial filing. If you found this breakdown valuable, please hit that like button and subscribe for more content. Also, don't forget to check out our Discord community in the description below, where we dive even deeper into these topics. What's your take on Ingersoll Rand? Let me know in the comments. Thanks for watching and see you in the next video.